Okay, thanks for joining me today. Today I'm going through inventory valuation, and I've got two questions for that. So it's basically just FIFO and AVCO, working out the value of the inventory, and then there's some lead-on questions like work out the gross profit for the year end. So the first question, Contador Limited has a financial year end of the 31st of October 2012. However, it was impossible to take out a stock take on this date. So they took the stock take on the 12th of November 2012, so after the financial end day. And that inventory was valued at 31,300. So something like that. And we've got a list of transactions between that financial year end and when the stock take could be taken. So we sort of need to work back in time to find out what the closing inventory figure was at the end of that financial year. So a good way to think of this is it's just how inventory goes in and leaves the company. So, question 1. So, say if I have 5,000, this is completely unrelated to the question, but say if I have 5,000 worth of goods in February, then I sell 1,000. Then let's say in February, and say my value of inventory in March is now 4,000. So there's been no other transactions. I have 5,000 worth of goods, sold 1,000, now have 4,000. So you just see how that inventory has just gone down because of sales. So the reverse is we're going to add sales back on to get back to that original figure in a sense, aren't we? We're going to go from the 4,000 from the later stock take, add the sales on to get to the earlier stock take. So that's sort of the sense of what's going on in this question. So we're going to add sales back on. And so what you can do is just do the opposites with the others. So the opposite of sales are purchase, so you can just minus purchase. What's the opposite of purchases? Well, yeah, it is sales, the opposite of purchase, but also what cancels out purchases? Well, it's going to be returns out. Returns back to our suppliers. And then we've got returns in, they're the opposite of sales, so just do the opposite. So what we're going to do, we're going to work back through these transactions to find out what the value of the inventory was on the 31st of October 2012. So we'll start on the 11th of November. It's always good to just think about what it is in an accounting sense. So, goods with a selling price of 1860 returned by a customer. So a customer is someone we've sold goods to, and if we returned it, that's simply a return in. So, we start off with 31,300. It's a return in, so we know we're going to minus away whatever we're doing. Okay, so goods with a selling price of 1860 were returned by a customer. Right. However, what do we value inventory at? We don't value it at selling price. We sell it actually at cost, what we purchased it for. And we see that selling goods were based on a cost price plus a uniform markup of 20%. So, say if we bought goods in for £100, we'd sell them for 120. We're just adding 20% on. £20 profit in a sense, 20% profit in a sense. So to get back to the original cost price, what we're going to have to do is divide by 1.2. And that brings us to 29,750. I believe that's about 1550, but I don't really need to work it out just because I can just use that sum in a way. So on the 7th of November, so that's the value now of inventory at the 11th of November, and that was the 12th, so we're slowly going back now. So on the 7th of November, goods with a selling price of 121,440 were sold to a customer. So that's just a basic sale. So I'm going to take that figure I've just worked out, 29,750, and what do I do with a sale? I add it, but once again, it's valued at selling price, so we're just going to have to do the exact same thing. 121,440 and divide that by 1.2. So that's now going to bring me a inventory figure of 130,950 on the 7th of November. So 4th of November, goods with a cost price, so we're not going to have to do any editing of the value because it's not selling price anymore. We don't have to use the markup or anything. 4th of November, goods with a cost price of 39,500 were purchased from a supplier. So that's just a basic purchase. So 130,950 from the previous equation. So it's a purchase. What do we do with purchases? We just take them away. 39,500, and that will give us 91,450. Okay, so now the 2nd of November. Goods with a cost price of 3,100 were returned to a supplier. So it's a purchase, but we've returned it, so it's just a return out. So 91,450. What do we do with a return out? We just add it. The return out is worth 3,100, bringing us to 94,550. And that's your answer. So that is the closing inventory, the 31st of October 2012, if you want to think of it like that. So, part 2. Inventory is currently valued using the FIFO method. Using this method, the gross profit for the business was calculated at 9240. So, what information can we put down here? Well, FIFO GP is gross profit is equal to 9240, and that is when the closing inventory is 31,300. Okay, so I've just lifted that value there. This is just for the period 1st to the 12th of November. So if you've got that question wrong, it doesn't matter in a sense. And so they're only working with the 1st to the 12th of November. Okay, so the closing inventory using the AVCO method was 31,100. So the AVCO closing inventory is 31,100. So what I can put in brackets is just 200 less than FIFO. So the directors of Console Limited are unsure about whether to change from FIFO to AVCO, so that's part 3. So calculate the gross profit for the period from the 1st to the 12th of November 2012 using the AVCO method. So we've been given the FIFO, so we just need to work with the AVCO now. So what we can do is just make a comparison between the two methods in a sense. So AVCO has a smaller closing inventory. CI is closing inventory, if you've not caught up on that yet, sorry. Just read it, it makes it easier for me. So it's a smaller closing inventory, and closing inventory is taken away from our cost of sales. So a smaller closing inventory is just going to make our cost of sales bigger. So we're going to have a larger cost of sales. So a larger cost of sales is taken away from our revenue to give us a smaller gross profit. So simply our AVCO gross profit is just going to be the FIFO gross profit, but just smaller. By how much? The difference, 200, which is 9040. And that's it. That's 3 marks. So part 3. What write is down. Explain 2 reasons why the directors should not change from FIFO method to AVCO method. Think of your accounting concepts. Consistency. It's not consistent, is it? Changing from one. It's going to be hard to compare these values, isn't it? Because it's using different methods. Also, if you use AVCO, it's an average, isn't it? And if it gives you this average, say £67.24, you never actually bought in inventory for that exact value. It's very unlikely. So it's giving you an inventory valuation that doesn't really exist in a sense. We've never purchased inventory at that figure. So sort of, it's not like it's not, in a sense, it's not it is relevant, but in a sense, it's not really showing much in a sense. So that's January 2013. And I've also done Jan 12. So, moving on to this. So, ALICID Limited sells surfboards at the 1st of November to 2011. They have 60 surfboards in stock, which cost a total of $9,570. During November 2011, the following transaction took place. We've got some purchases and some sales. ALICID Limited uses the AVCO method of value inventory. Using this method, the inventory at the 30th of November 2011 was valued at 11,739, and the gross profit was valued at 2798.7. Directors of the side are considering changing, so it's just the same thing again, really. So what firstly I thought I'd do is prove this, because neither of these questions allow me to show how AVCO works. So I thought I'd just do that. So this isn't relevant to these parts, I just want to show how AVCO works, because it won't let me the questions it says. So on the 3rd of November, what do we have? Well, we have the 9570 plus the 40 times by 165.5. So that's the total inventory we have on the 3rd of November, which is just 16190. I'm just going to put in brackets 100, because there's 100 surfboards. We've got 60 from the start, and then we've purchased 40. So now, on the 10th, we sell 45. So I'm just going to put in minus 45 there. There's loads of different ways and methods, but they all do the same. They all do it the same way. But AVCO and FIFO, there's so many different layouts you can use. I have my own personally. So on the 19th of November, we have, well, we sold 45 of these 100. So what I'm going to do is 16,190 times by 55, 100. I hope you understand where I've got that from. I've just done 100 minus 45, 55 over 100. So we've got 55% of that inventory left now. Plus the purchases we made. 55 times by 173.5. So that brings us to 18,447. And so what do we have here? We have 55, well, we do 100 minus 45, which is our 55, plus another 55 surfboards, so that's 110 surfboards. So it's just kind of nice to just know how many surfboards. It just gives you a bit more context to it. So what I'm going to do now is I'm actually going to average this. So AV average. The average of this is 167.70. Okay. So now on the 26th of November, I'm going to just use this sale to find our closing inventory. So always the sale price is always irrelevant in this. We don't consider that in any way. We only care about the purchase price. It doesn't matter what we sell it for, because selling price is irrelevant to inventory valuation, isn't it? It's only cost we care about. So what I'm going to do is 167.70 times by, okay, well, we had 110 surfboards and we've just sold 40. So minus 40, so that's just 70. And that brings us to 11,739. And there it is, 11,739. It's just been proven. It just shows you how AVCO works in a sense. So now I can move on to the real questions. Point 5, calculate the value of inventory using the FIFO method. So this is how I laid out. Everyone lays it out different. I was taught a certain way and I just changed it a little bit. So what I do is I always put the dates of the purchases on the right hand side. So the 1st of November, the 3rd of November. The 1st of November represents the opening inventory, and the 19th of November. And in the brackets, what I'm going to put is the average purchase price. So 159.50 is simply 95.70 over 60. That will be the average purchase price. We're given them in these two, so it's just 165.50 and 173.50. So on the top, what I do is I put purchases. So I have 60 at the start, then I purchase another 40 on the 3rd, and I purchase another 55. So you can see where I've just lifted that from. 60 at the opening, brought in 30, brought in 55. And now what I do is I put the dates of the sales on the top. 10th of November, 26th of November, and then at the end this is like the closing inventory. what we have left after our sales. So the first sale, so and at the bottom here I always have the bottom the total sales for each of these dates. So I sold 45 on the 10th and I sold 40 on the 26th. You don't have to use this method, this is just something that I use. I'm sure there's 100 methods out there that your own teachers teach you. This is what I use. So on the 10th we sold 45 and it's first in, first out. So the first batch of inventory is this. I'm just going to take away 45. So you see this 45 equals that 45. So we've untouched the third. We can't have touched the 19th yet because we're selling it before we've even bought that in. Now 40. We've only got 15 left because after the 60 take away the 45, so we can only take away 15 from there. However, we still need 25 more to get to this 40. So take away 25 from the next date. So on the 30th we're left with none from the first November batch. We're left with 15 and then 55. So how am I going to work out the closing inventory now? Well, it's relevant. These are now very relevant. So closing inventory equals 15 times by 165.50, and then we've also got 55 surfboards which we also purchased at 173.50. So that will come to 2482.50, and that will come to 9542.50, giving me a grand total of closing inventory of 12025. And that's it. So part 6. So it's another just calculate the gross profit really. Calculate the gross profit for the month ending the 30th of November 2011 using the FIFO method. So it's sort of, in a sense, the same as what we've done here. We're given the gross profit and the closing inventory for one, but only the closing inventory for another. So you just sort of got to just compare them in a sense. So we've got the AVCO GP. Well, it was valued at 2798.70 with a closing inventory of 11739. The FIFO CI, well, I've just worked it out, is 12025, which is £286 higher. So what do I do here? Well, it's I want to calculate the FIFO gross profit. So I've got a higher closing inventory using the FIFO method, meaning a lower closing cost of sales, meaning a higher gross profit. So what's my FIFO gross profit? Well, it's basically what we did in the last paper. We just did FIFO gross profit is equal to the 2798.70, which is the AVCO GP, but 286 higher. And that's a criticism of FIFO. It tends to give a higher gross profit, which is kind of artificial in a sense, because it's only this extra gross profit has only been created because of the way we value our inventory, not in the way we've sold stuff in a sense. So that's it. Just make sure you know your methods. If you know your methods, you'll be fantastic. The reasoning behind why we shouldn't change, why we should change, the IAS is behind it. Any emails, of course, always email me, theaccountingtutor@gmail.com. I'm happy to answer any questions, any queries, and I'll see you in the next video.